Welcome to Moving Iron with Casey Seymour and Greg Peterson, the podcast for anyone and everyone involved and interested in the business of ag equipment. If you want to understand what trends and market forces are impacting the price of your iron, you've come to the right place. Buckle up, it's time to move some iron.
Hello and welcome to Moving Iron Podcast. This edition of Moving Iron Podcast is brought to you by John Deere. I got Greg Machinery, Pete Peterson on to talk about what's happening. Greg, how you doing today?
I'm doing well, Casey. How are you doing?
Doing good, man. Doing good. You survived Christmas. You know, you did some traveling, so make it feel all right.
We went out to visit our daughter and grandson out in Ohio, and he's about coming up on 2.5, so he's really into trucks and tractors and trains and helicopters, and so we had a good time catching up and got home to Minnesota. Got a little post-Christmas blizzard, so yeah, all is right with the world, I guess.
Right on.
How about yourself?
You know, I can't complain. We did didn't go anywhere, stayed home. We had some abnormally warm weather here in the Panhandle. I want to say Christmas Day was like 62 degrees, and
wow.
We got to mess around. We were going to go play around the golf, me and my son, but we just kind of had one thing led to another. Next thing you knew, it was 3:00. We only had about an hour of daylight left, so we were like, we'll skip it. But the novelty of playing golf on the Panhandle on Christmas Day would have been something said about that.
No option to golf as I look out and see 10 inches of snow and 5 degrees here in Minnesota. So I'm envious.
You have to use an orange golf ball. That way you didn't really have to spot it down when you got there.
I guess. Heat-seeking orange golf ball.
That's right. I was talking to my son the other day. I was like, it's 2025, and you figure by now somebody would have a golf ball you could hit that would hook to an app somewhere that you could find it no matter where you hit it at. But
exactly. I used to write a golf column for the Rochester Post-Bulletin, the daily newspaper up here for years. And I think it was like 10 years ago, the editor said, hey, why don't you give us a futuristic golf column? And I said, okay. And I said, just what you said. Yeah, we should have these little teeny tiny microchips in the golf ball. So we don't lose them. They're so gall darn expensive. But then also get that, the shot tracer right on our phone. So when I hit a banana ball in the trees, I can look at the pretty curvy line, but I can find my ball. So maybe that's just another 10 years out. I don't know.
I think it's a conspiracy, Greg. The golf ball cartel won't let that happen. So.
Yes. Corporate America, yeah, no, but it doesn't seem like it should be that difficult these days. We just need the cost of these teeny tiny microchips to come down a little bit. Maybe the golf industry could learn some stuff from the farm ag industry and incorporate some of that stuff.
Yeah, maybe. I could sure use one of those things because I seem to lose more golf balls than I find when I play golf, so.
When I was a little kid, me and my brothers, we lived right on the golf course in our little town of Benson, Minnesota. We used to spend summers walking along the cornfields of the course looking for golf balls that people sliced into the corn. And, you can make a little money. Make a few quarters and go to the Dairy Queen, buy yourself a dilly bar, and life was simple.
Yeah, about this time every year, I see on Facebook Marketplace somebody selling, they've got a trash can full of golf balls that they've gathered up, and I buy them for like $100, $150 or whatever it is, and I get 200-300 golf balls out of the deal, and I usually last me about 5 or 6 years, and then I get get another trash bag full of golf balls. So yeah. Anyway, if I learned how to not slice or hook, that's the thing. I don't know if I'm going to slice or hook it or if it's going to go straight when I hit it. So
it's problematic when the misses can go both ways. That's that's not good for low scoring for golf. I feel your pain.
It's grip and rip. That's all I say. You know what I mean?
Grip and rip. As long as you have fun.
Where it goes. Yeah.
As long as you have fun, who cares what you shoot? That's my philosophy.
Yeah, it's a good time. Good time. All right, Greg. Here we are at the end of the year. We've been doing this podcast now for 1 year together here, and we've had a lot of great conversations along the way. And one of which we've talked about since the beginning of the year was how the auction market was coming back and how we were starting to see some consistency in stabilization of the bottom, and that just got firmer and firmer as the year went on. We've seen retail prices come down, and we've also seen the amount of equipment that's on the marketplace start to shrink right along with that. All stuff that we talked about coming into 25, and all stuff that we've tracked all the way through. I guess as you look back on 2025, what were some of the big aha moments for you that really pointed towards, correction in the marketplace, healing up in the marketplace, whatever it might be, but just some moments in 25 that you look back on and say, these are some turning points for me?
Well, that's a good question, Casey. Covering auctions for all these pushing 4 decades, usually there are bellwether sales with results that you go, wow, the market maybe turned on that day or began to turn. I think for me, 2025 is just the consistency of the market. To me, the whole used equipment space has become so much more efficient. So we, as we talk through the year every week here, I mean, it was literally about the 20th of February of 2025. Auction prices went up a little bit and they just kind of stayed there. Now it's interesting because everywhere I go, and I traveled a lot end of the year out to auctions and different events and things, and I totally understand it, but people are coming up and online, they comment like, oh, used equipment values are, but you got to talk facts, and facts are that used values solidified. And then we came to November and December, and they actually went up a little bit. I'm talking values on good condition used equipment. So to me, it was surprising because I think 2025 will be the year we look back at as kind of a big change in the whole farm equipment space, because there's always been ups and downs based on farm income, price of corn and beans, whatnot. But the lags, the downtimes, it used to take, like the last big downturn, again, we've talked about 2014, end of 13, 14, 15, 16. That took like about 3 years until I started to see the auction prices solidify. This time it took 1 year, and it's holding so far. So I think it plays into those things you mentioned. Overall, inventories come down. Is it tight? No. But it's tighter, definitely, than it was a year ago. And sales of new are still, very, very sluggish. In fact, it's almost surprising now when you see a 2025 item show up at auction. It's like, whoa, look at that. So that AF11 we saw up in Alberta or wherever it was a couple weeks ago. 2025 is just, to me, it surprised me how just consistently solid auction pricing has been.
Yep. So I think for me, it's two things. One is I think the biggest thing for me as I look back on 2025 is there's always been these little, road signs that I pay attention to when you're going through a downturn like this. One of which was older 6 to 10-year-old stuff and the values associated with those. One thing I've always said about those machines is that when you get to a certain price range, there comes a point where the demand for that goes up and you start to see values of that go up. And we saw that happen this year, right? You didn't see that happen in 24, 23, but 25, you sure saw that really nice late model, lower houred stuff, earlier model, low houred stuff come through where we were seeing some 5,000 hour tractors and 3,500 hour tractors and even some, 1,200 hour combines, stuff like that, where they were older machines, but they were really well taken care of. They looked good. The inspections looked good on them. Everything about the stories behind them, really correlated great with the condition of the machine and everything lined up. And you saw some big numbers come through on some stuff, which again, to me, always points to, hey, we're seeing some things out there that show some leveling of the ground starting to happen there. The other thing for me that really kind of jumped out at me a little bit, and I expected this, like it's not like a big drawback by any means at all, but if you go back and look at where price increases went during COVID, the COVID outbreak between 2020 and 2023, and go back from 2017 to 2023, that was a 5-year period in there, 5-6 year period in there that you're looking at price increases happen. The biggest chunk of those price increases were from late 21 all through 22 and into early 23. But there's like 10 years worth of price increases that happened in like a 5-year period, right? So the price of new equipment just blew the top off, right? I mean, it's just blowing up big. Because of that, earlier, the order writing periods for all the manufacturers, there's not a lot of 1-year-old equipment on the marketplace, right? And we're going to see that carry over into 26. I think that you're going to see a lot of 1-year-old equipment come back in 26 either. So you're going to have this 25 model year stuff and this 26 model year stuff where there's not a lot of pressure on the upside of the curve, right? The top end of the curve where the most expensive stuff is, pushing down on the older stuff. So if you look at where the market is now, there is a strong amount of equipment in that 3 to 5 year old stuff, which is rapidly coming off the market, which I was kind of concerned about. If you watch how much of that stuff moved off the marketplace in late November through December, it was at a higher acceleration pace than I expected it to be. And so as you watch that stuff move through there, that you saw a lot of that stuff come off. Where I think the market's setting up for 26 to really put in a really healthy condition is that in past years, when during down cycles like this, the front end of the curve was so high with 1 and 2 year old stuff that was really low out and very expensive compared to things below it, that it was hard to get those machines moved into different brackets through trade cycles to get more machines in those buckets. But what we see happening today is there's not nearly enough machines at the top to feed what's going on at the bottom, which allows the mid-level stuff, that 3 to 5 year old stuff, that 6 to 10 year old stuff, to really have a chance to really, lack of a better term, kind of cannibalize itself and really trim those numbers down to where we get to a really healthy spot going into 26 or going through 26. That, in my opinion, we're kind of setting the stage for what the new normal might look like as we push our way through this. Longer trade cycles, less machines on the top side to where they can feed the lower side. So it's going to force people into having longer trade cycles or upgrade kits or whatever their strategy might be, just because of the price of a 1 or 2 year old piece of equipment it is right now. I think we're kind of setting ourselves up for that new normal, and it's going to have new guys are going to continue to buy new. But that 80%, that 20% that always buys new, and that 80% that kind of falls in there maybe once in a while, they'll buy something new, or they're on the lower end of a trade cycle where they buy something new every 3 years and then they run it for 3 years. I think that changes up a little bit, and we're going to see less new equipment being sold, more used equipment being available because of longer trade cycles. And I kind of feel like as I watch what's happening right now and as I look into 26 and the conversations you and I talked about here where guys are stepping back going like, Dad Grandpa farmed this same farm with 3 tractors and we got 6 now. Do we really need to have 6 tractors, or do we need that extra common that we've been talking about? So that changes the landscape a little bit, where I think it ushers in a new normal in 26 that really points towards a less machines on the farm, more hours, longer trade cycle.
I agree completely. I think the issue of the thinness you're talking about there on the 1 and 2 year old stuff used available, and you documented a couple of weeks ago. We were on here talking, and you pulled up numbers that showed it, the number of 25 models. Couple things. One, I think if I'm a manufacturer, I'm smiling from ear to ear, honestly, because of that fact you just described. This space it's not going to have the problem it had previously of that overhang of 1, 2, 3 year old stuff that just kind of clogged things up. Now, on the flip side, if you're a farmer, and again, this is why I right about a year ago, I wrote that column for Farm Journal, and I said, whoa, eyes wide open here, folks. Like you said, this is different. That was then, this is now. And now things are moving quick. So it's a you buy it, we'll build it. That thinness of 1 and 2 year old stuff, you don't really notice it so much now, but when corn and beans jump up, whenever they do, hopefully, if that's a year from now, a year and a half, 2, I don't know, who knows? You're going to get people that maybe want to come up and get up into that 1, 2 year old stuff, but guess what? It's not there like it was 10 years ago coming out of that down cycle. It's just not there. So I think that's why we're seeing, that the auction pricing on good condition used across that whole spectrum solidifying. For example, December 23rd, right before Christmas, shut down on the auction front. We had a nice S770. It was a 20 model. A Big Iron sold it. It was out of Iola, Kansas. It was a 20 model, 1,140 engine hours, KC. went for $229.25. That's a 20 model and a nice machine, like you said. Those nice machines, there's demand. Now, average auction price in 2025 on a 20 model S770 is about $186,000. Now, it's interesting because when you compare it to the average dealer ad price on a 20 model S770, which is about $256, you do my machine repeat ratio, average auction price as a percentage of average dealer price, it's 72.6%. And that is actually the exact norm the 26 years I've been tracking this.
Yeah.
Now, if we'd have done this 18 months ago, my machine repeat ratio on late model combines was like, 64%, 63% and falling. So it's just different now. And again, I think that lack of 1 and 2 year old stuff sitting there on the lot or at auction, on the auction side, it's making the prices stronger. Yeah. So I agree completely with everything you laid out there.
Yeah. And I think one thing too, just like you're talking about there, is that it seems like these numbers are significantly bigger than they are in the past, because they are, but the percentages are about the same. And that's the thing that, if you look about it, my rule of thumb has always been about 25% on a 1 year old machine. And then, you kind of, it dictates market by market what a 2 year old machine's worth, but somewhere you're going to lose another 10 or so percent on the second year, and you're going to lose another 10 or so on the third percent. And then it really starts to taper down past that. So when it's all said and done, but 25% now, that's a big number with the price of machines, right?
Right.
You're talking $800,000 something, that's, you do 10% of $800,000, that's $80,000 times 2 is 160. Half of that, again, 40. So you're at $200,000.
Right.
$200,000 swing, where that used to be 50 grand or 100 grand or 150,000 or something like that. That movement has changed dramatically. And, discounting and those kind of things you see from the factory, they're stronger now than they're going to be. And I think that's another thing, too, to pay close attention to, and how that affects 26 and the used equipment market spaces. Because as soon as discounting starts to come out, if they're discounting above and beyond normal discounting levels, that affects the used equipment space, too, right? I mean, so if you're seeing some 5% discounts on combines, an additional 5% discount on combines or something like that, a 7% discount on sprayers or something, whatever it might be, right? That 7% now offsets against used, and depending on where the used market's sitting at, that can stagnate the used market pretty fast. But again, new prices are so high that it's going to take a significant amount of discounts to really make anybody be like, I don't think I'm going to go ahead and pay the extra whatever for that.
Yeah, this I'd never written much about the K-shaped economy, specific circumstance, which we're totally in right now, and I think it's becoming. The K is just getting larger and larger as we go here, not just in ag, but our culture in general. The incredible price increases you talked about on new farm equipment. Obviously, it goes across so much. I mean, look at home prices over so much of the U.S. Now, who does it benefit? It benefits the older folks, boomers, plus got their house paid off and sitting there watching it go up, up, up. Well, what if you're 25? And you got a good job out of college, you're trying to pay off your debt, and you want to get a house, start your family, and it's like, I can't buy a freaking house. They're too darn expensive. So then I don't start a family. So it's interesting to me, Casey, what I'm starting to see as this K-shaped economy gets wider, basically haves and have-nots. Collectively, we're starting to go, whoa. I mean, we can't completely eat our young, so to speak. Now in ag, of course, this problem has been around for a long time. The challenges young folks have, if you don't inherit a farm, how the heck can you crack in? And it's, I don't know, we tend to look towards government for solutions, but I think now we're also getting to the point when government's not going to help. We can't depend on them for anything. They just break stuff.
Right.
I was encouraged, I will say. I was in Windsor, Virginia, covering an auction on December 20th, a really nice farm retirement auction. And a young guy came up to me, maybe 30 years old, and he just had a specific question, like, hey, Pete, what do you think this Draper head's worth? So we talked a little bit. and when you know how it is, you talk, once you get past a few minutes, then I ask, well, hey, tell me about your operation. And this is a young guy who just smashed in on his own. And he said, Pete, I started by moving snow. I just ran all the time. I bought a tractor, another tractor, plow. Then I got some land. I started chipping away. And I'm like, this is awesome. Is it easy to do that? No, it's super hard like it's always been. But I think we need to start to figure out a way, to help, transfer a lot of, I think listeners understand what I'm getting at here, and there's no easy solution, but you document the price of used equipment going up, new equipment up. And it's, even at the manufacturer level, to me, they should be thinking somewhat about, not just the person who can write this check, but what can we do to foster, a healthy space so that we have more customers 30 years from now. And these numbers have got so big. Like you said those price increases, 21, 2, 3, 10, that was maybe like 15 years worth of price increases. And then it hasn't come down yet.
No.
That's the one thing now to me is the manufacturers are just clinging to that new price point. And I understand they don't want to go back. Going back is a slippery slope. But now, because what we just described, at least they don't have the problem of all the 1, 2, 3-year-old stuff piled up on dealer lots. So it might, like you said, it might allow them now to go, well, at some point, okay, here's a little break on this whatever, combine, this high-speed disc, this tractor, whatever. 26 will be interesting to see how they play it at the manufacturer level, like you said.
Yep, for sure. And I think, like you said, it's one of those deals where you watch this thing move and all the parts that go with it. I think this ushers in that, I have a 3 to 5 year old combine. I typically go get that 1 to 2 year old machine and bring it back into the farm, and I run it for 2 or 3 years or whatever it might be. That trade cycle, it's a pretty common trade cycle. Yep. But I think that trade cycle is lengthening out. But I also think that opens the door to, I could spend $550,000 on a used something, or I can upgrade it for half that much. And I think that, or 60% of that much, or whatever the number is, right? It's less than going out and buying a complete good machine.
Right.
Those conversations are being had. More people are taking a look at that, which then again, that throws a whole nother wrench, kind of a proverbial wrench into the gear system over there, because now you're taking a used buyer out of the marketplace because of the upgrade kit situation that's there. So
yeah, one thing, there's
a lot of moving parts there.
I think makes me think of a friend of ours, Casey, when you go down that road, Jake Bryce with Machinery Scope. I thought recently here, extended warranty, we had an auction, and I know the auctioneer reached out to me with a note, and, they sent me the info on the sale, which then we do a promo on it. But they were like, hey, Pete, be sure to mention that this combine has, the max extended warranty. And I was like, okay, thanks for bringing that up. That should be right at the top of the listing. So yeah, if you're going to be selling any piece of equipment, folks, private or auction, go to machineryscope.com, check out our friend Jake there. The value in this current situation, like you just said, as the life of the equipment gets stretched out farther, that extended warranty is really important. Or like you say, it almost tilts you back towards, well, if I'm spending $500K on a couple-year-old one, maybe I should just buy a new one. And again, that's a good condition if you're the manufacturer. They're kind of sitting there waiting for it to kind of tilt back that way.
Yeah, it's going to be interesting to watch 26 evolve and how it does. But again, I think we're kind of setting the stage for what the new normal looks like. And I think we're going to continue to push down this path of less brand new off the shelf machines coming out. Just again, because it comes back to who can truly afford that whole scenario. And typically the ones I think that are going to be the ones that be able to afford that are the ones that are buying equipment at enough equipment to hit maximum level discounts by all the manufacturers. And that's just going to be, watch to continue how that moves along.
Right.
Which end up, but I think again, like I said, like if you look at 3 to 5 year old machines, that's the biggest chunk of machines out there. And the last time this happened, 12, 13, 14 machines were the biggest chunk of used equipment, and they're still, I mean, it's still out there now. If you go back and look at that kind of, there's still a big hump out there of those machines. This is going to be different, where there's not going to be enough backfill of new machines coming in, that it gives that opportunity for that to flatten out and really fit the marketplace, which it really excites me for the used equipment space. And what's that do for pricing? What's that do for stability? What's that do for balance sheets? I think that does a lot of things that we didn't see happen in 17, 18, 19 because the amount of 12, 13, 14 model stuff that was on the marketplace. I think it completely changes the landscape and ushers in a more sustainable used equipment space that is not this high highs and low lows. It's more vanilla and a lot in the middle there.
I agree completely. In fact, I would have data proof of that, because that last downturn you just referenced, Casey, I've written about this a lot. But if you could folks, you can go into machinerypete.com and look at the auction prices and go back. So I invite you to go back to 2014, 15, 16 and look what like an 8235R sold for with 500 hours or 800 hours. So that 3 to 5 you're talking about, if you would have bought 10 of those low-hour ones, red, green, blue, whatever, back then, and just kind of used them a little bit, keep the hours low. I mean, hello, Merry Christmas and what they're worth now. But this time around, because of like you say, this is a new normal. You're completely correct. It'll just be fascinating to see how it plays out. But the vanilla-ness you described, that is a really good thing. It's just a more even space. To me, the used farm equipment space is catching up to the used automobile space in terms of velocity. And I think, again, if you're a manufacturer, that's a good thing. If you're a farmer, you just have to be aware of it. You don't have to like it, but you got to be aware of it. The ins and outs, ups and downs, and where those opportunities are. There's always opportunities. But if you just assume it was like it used to be 10 years ago, you're going to get flattened.
Yep, for sure. And I think, again, that's what you start looking at trend lines. And we both talk about this all the time on here, but data doesn't lie. You got to figure out what that looks like. And just because you start seeing something dip, you start to see a auction value raise up or a retail value start to raise up, or you're seeing more demand or something like that, doesn't constitute, all right, this is the new, we're gonna go in here and we're gonna sell a bunch of new stuff. We're gonna go out and make new things happen, because I think you have to have some caution when you're going through those things, right? Now, the other side of that argument is you've got to sell new equipment to generate used equipment that can then feed the beast, and you got to figure out what that looks like too, and you got to make those kind of things happen. But at the same time, shoehorning in a new sell when they should have been a used buyer, I'm going to say this: buyer beware. You know what I mean? Like, if you're typically a 1 to 2 year old buyer, stay a 1 to 2 year old buyer. Don't jump in and buy that new piece, because it's going to mess up. It messes up what it looks like if there is another downturn that comes. And if you look at past history with the COVID thing, that deal snapped pretty quick, and it went sideways really, in about 18 months. But it also recovered, air quotes here, and stabilized in 18 months too. So this was a significantly shorter amount of time to feel significant pain and some easing of the pain in that time frame. Where in the past, it's typically been 4, 5, or 6 years of really good times, and 3 to 4 years of cleaning up the mess and then getting back to the new normal. Every one of those cycles, if you go back and look at where those cycles were, they all have gotten shorter along the way. And This one was really short again. So I'm not saying that, hey, the next one's going to be 6 months collapse, and then they're going to be 6 months again, we're going to be back to normal. Because the farm equipment economy doesn't work that way. It's everything takes a year for the bad stuff to happen and the good stuff to come back in. So, but what I'm saying is those drops in pricing and drops in value and drops in market conditions and those kind of things are going to be significantly faster than they've been in the past, just because of the dollars associated with it, right? I mean, you lose 10% on a $500,000 something, that's $50,000, right? But most of the time you're losing 40 cents on the dollar when you take stuff to an audit during the collapse 50 cents on a dollar on a cotton. So you're talking $250,000. Talking, 400, 100, $200,000, $150,000. Those swings are dramatically bigger now, even though the percentages are about the same.
Right.
Their swings are just dollar-wise are huge, are a lot more impactful than they have been in the past.
Right.
That changes things dramatically.
Yeah, I guess, to wrap things up from my seat, Casey, as we go into 26, two things that I'm really keeping an eye on. One is, this lack of new equipment sales has stretched out for pretty long now.
Yeah.
And I've never seen in my 36 plus years a condition where, like we talked about, used values are solidifying to rising a little bit. That is always equated to increased conditions to sell new equipment, except not this time. There's no corresponding. Used is going up, so new is going to take off. No, I've never seen this before. So at what point is it mid 26, late 26 into 27 when, and that might be to your earlier point about at the manufacturer level, like we got to sell some new iron here. And well, what does that entail? How are you going to goose that condition? So that's one thing. The other thing I'm watching is at the farmer level. This downturn, at least on the grain side, is stretched out long enough now. And we live in a different age when we're doing podcasts like this and people are on TikTok and the information flow is it's dizzying, right? But to me, from a data perspective, as I absorb all this content, it's been interesting to note the number of farmers talking about, like you said before, do we really need 6 tractors? Maybe we can do 3 or 4. And we're not going to go back down that road again. We don't need that third comp, whatever. And to me, that reminds me exactly what dealers were saying a decade ago in the mouth of that beast, of that 1, 2, 3-year-old overhang that was so huge. And what dealers said back then is, never again. We're never going to do this. We're not going to get ourselves in the same spot. Now, it's one thing when the dollars are tight, but whenever the dollars start to flow in ag, will that farmer mindset stick? You got the price of new way up here. Will it stick? And so those are two things I'll be fascinated to see how they kind of play out.
Yeah, for sure. All right, Greg, good place to stop. Appreciate everything, this year, working with you on this podcast. A lot of fun. Enjoying it. So really look forward to what's going to happen next year. So folks, I'll reach out to you. Best place to do that's on TikTok, or not TikTok, X, and I don't know why I said TikTok.
The one place Machinery Pete is on TikTok. But
that's a hard place to maneuver. I'll be honest with you. TikTok is an odd animal.
I'm just a chicken. I haven't dipped my toe yet. Maybe 26 will be the year Machinery Pete tries TikTok. How about that?
There you go.
No, just hit our website or social media, folks, again. And, hey, hats off to you, Casey, for moving on your podcast, what it is, how you're helping the whole space here. And great fun this year, and look forward to 26, brother.
Right on, man. Well, Greg, looking forward to working with you again here in 26, making sure things keep pushing down the line here. So with that, we'll talk to you again next week.
Sounds great. Have a good one, Casey.
Stay tuned for more Moving Iron podcast after these messages.
Looking for more accuracy, more productivity from your current planter? Let's get exact with precision upgrades from John Deere. Start with Exact Emerge and get accurate singulation and spacing at 10 miles per hour. Or choose Exact Shot to promote early root growth and cut fertilizer costs. And with Furrow Vision, save time by verifying seed depth right from your cab. Visit johndeere.com/planner upgrades and see why nothing runs like a Deere.
All right, welcome back to Moving Iron Podcast. Marcus, we got Sean Hackett on here for the last week of the year and run down a little bit what we saw happen. Sean, how you doing this morning?
I'm doing really, really good. Looking forward to unplugging a little bit, which I rarely do, into the end of the year and getting fired up for what the trends might be for 2026. So
yeah. So 25 is a year a lot of people want to forget, right? And it feels like we've had a lot of those years people want to forget over the last 5 years. But when you are kind of looking at how things went, we saw some back and forth stuff in the marketplace. We saw things, price of corn came out of that with a 3 in front to where we're at now. We're bouncing around that 436. You throw basis in there and those kind of things. You're in the high 3s, low 4s, depending on what your basis looks like. We've seen some back and forth on the political side when it came to what happened with China, what China's going to buy and not going to buy. We've seen some monetary policies come through where we're seeing some, lowering of interest rates. Now they're kind of back on the fence of maybe we should not lower interest rates, but we're going to get a new Fed boss, so that's going to change things around. So I guess, John, as you look at 25 and you see how that set the stage for 26, weather-wise, we've seen some cold weather like you've talked about. We got a little bereavement from that right now. Where I'm at, we're up in the 60s right now, but you also talked about that split between two big cold blasts as they came through. But as you're seeing how 25 sets the stage for what we're going into 26, what's your thoughts and what's your feel for how we're going to move into next year?
2025 was the year of chaos, headline risks, endless tariff volatility, and it just made for a very, very challenging year for everything other than essentially the precious metals and maybe throw copper in there. Other than that, just a very difficult year, too many headwinds, too much uncertainty, no one knowing what the rules of engagement were going to be. And it's been a challenging year for those that produce most commodities. So where we're ending is that the Federal Reserve, I really don't think interest rates are that important. More importantly, are they expanding or contracting the balance sheet? And they made the big statement in the last Federal Reserve meeting is that they've ended quantitative tightening, which is taking money out of the system, and are back to quantitative easing, $40 billion a month that they're going to be pumping into the economy right now, reinitiating quantitative easing, meaning adding to the money supply. It takes time for that to have an effect on markets. It's not instantaneous, but we haven't seen a shift from quantitative tightening to quantitative easing since 2020 when COVID hit, and we obviously, did some wild things with monetary policy. I'm not expecting those kind of wild things, but nonetheless, we're now moving into the printing money again. We are going to have to roll 15 to 20 trillion U.S. government debt over the next 12 to 18 months, and the only way you can roll that and add more debt is you need to add liquidity, which is what quantitative easing is all about, is adding enough money to buy those bonds so that the money can roll over and the government stays in business. So that has always been an inflationary tailwind to hard assets, to commodities in general, meaning that all boats will float higher. Now, it doesn't mean they all float at the same rate. It depends on the fundamentals of each market. But generally speaking, if you start printing enough money, everything will rise at differing rates based upon the supply demand fundamentals. The markets that tend to react to this early and first are your precious metals, things like silver, things like gold, even platinum oftentimes reacts to this. Sometimes palladium even reacts to this. Anyone following what we call the white metals, that's the only place that we've been in a bull market. And because they're seeing this monetary inflation up ahead, and they tend to surge first, and then the energy and the ags, come in behind it. They took off in 2020, way before any of the other commodities took off, and then the other commodities took off as we got into 21. I think 21 is an analogous year to 2026. Not the same trajectory. I'm not printing that kind of money, but in terms of the timing of liquidity, I think 2026 is a pretty good year for hard assets overall. So that's the monetary side of it. So that's extremely important to have that on your side if you're going to be looking at a favorable environment for overall commodities. For agriculture specifically, obviously, Mother Nature is very, very important. And so when we look at the weather right now, the weather's been very, very good for South America for the first half of the growing season. There's been no major heat. We've gotten some very, very good rains here in the last 2 to 4 weeks. Soybean crop's going to be very good. We're going to have a big harvest starting in March. And even though I do believe that the second half of the growing season that we define from January 1st through May, the end of May, is going to be on the drier side. We still don't think we're going to see a lot of heat, Casey. And, if you don't have a lot of heat, you can have below normal moisture and you're still not going to have major crop problems. So I don't think we're going to get a weather catalyst from South America. I don't think that's going to be the thing I'd be looking for in terms of weather. What I do think could start to happen is we move into our spring, and we talked about this on your show before. And, we could have a large snowpack melt, riverbed flooding, some late stage winter type weather that could make for an unideal start to the planting season, and then obviously we get into our growing season. Now I want to set the stage. Right now we're in a weak La Nina. We've been in a weak La Nina. We're probably at peak La Nina, and we're going to start to weaken this La Nina. And by the time we get to the spring and by the time we get to the summer, we think we're going to be neutral to neutral positive, but no El Nino through July, August. And then we think we go into an El Nino in the fall and into the fourth quarter. So if we set the stage for this, Casey, what that essentially means is we are likely to have much greater weather concerns for the month of July this season than we did last season, because we're not going to be in El Nino. We're going to be sort of in a transition. And we're going to have I think, last year we had no weather related rally at all during the entire growing season. Zero. I think we could have a more traditional, mid-late June into July weather spike on warmer, drier weather. And then if we enter El Nino in the fall and into the fourth quarter, El Nino means hot and dry for central northern Brazil, where they grow the majority of the soybeans. So I think the weather variable is negative until the spring. And I think the spring is when we start to shift the weather variable from a negative headwind to a positive tailwind, parlaying into our growing season with a slow start to the planting season and some issues in July to very challenging soybean weather for the third and fourth quarter. So if I'm thinking weather, I'm thinking the turning point is going to be the spring. What I see here in the first quarter is, in terms of a catalyst, would be for corn. The USDA report in January tends to get fairly close to the truth. Doesn't mean they get all the way to the truth, but they tend to move aggressively towards the truth. We've used and we've seen AI modeling of actual harvest results from across the entire grain belt that compare same acres to last year to this year, and compare the two and show that the overall yield performance of actual results that came out of the field, not by my perception, but by AI modeling of actually, saying what actually happened versus last year, shows a crop yield slightly lower than last year, Casey. Slightly lower. Last year, I think it was 179 and change. So the AI modeling is saying it should be 178 and change. That's where we should go. I'm not saying necessarily that the USDA is going to be willing or able to do that, but I think we could come down substantially in this report in January, maybe 180, 181, something like that. And then they could screw around with quarterly grain stocks to get the number down to right. But if we eventually work that number through, it means 1.5 billion bushel carryout for corn. And that to me is an upper $4 corn market, not a low $4 corn market. It's not the biggest move in the planet. It's not a career retiring price level, but you can kind of make that pencil out a little better. Upper fours, maybe low fives if we get a spike trade like we had last year, versus upper threes to low fours that we've been dealing with since the late summer here into the end of the year. So that's the catalyst for corn. Soybeans, I think we've made our rally. We had our rally on China's going to buy a few soybeans. I don't think the yields are going to change much in the January report. The AI modeling does not show much of a change, that the numbers are pretty close to being right. So I kind of think we had the rally in soybeans. We've had the opportunity to sell. We had that $1.50 rally, and with a good crop coming out of Brazil, I think we've made our highs in soybeans for a while. I personally think that whatever that was, 11.5, 11.75, whatever the number was exactly, I think that might be it for a while. I'm not saying we're going back to the lows, but I think we made our highs and we're sort of range bound while corn catches up and prices higher. Everything that I hear from my customers, everything that I heard on my travels in my speaking engagements that I've been at, suggests a lot of corn is going to get planted if weather permits here in the spring. A lot of ground has been worked and has been prepared for corn. I'm not saying we're planting 100 million acres again. That I think was a bit excessive, but I think we could plant every bit of 97 or 98 million acres of corn. I think that's what I'm hearing. We're going to try to plant, and that means we're going to have another low soybean acre number. So the time to get excited, to get re-excited about soybeans is after Brazil kind of sells what it has to sell as the supplies come here in March, and we start talking about another very, very low soybean acreage number. Throw any weather issues. China keeps buying what they're going to be buying. Maybe we finally clarify the rules on renewable diesel. What a thought. Maybe we do that. You could see how soybean prices could get more bullish from spring onward. Not necessarily specifically in terms of Mother Nature necessarily, but there's just not going to be enough acres that we're going to be. You won't need a whole lot of margin of error there to get yourself into trouble. So long as China just maintains some level of decent purchases, which I think that they're going to. It's an election year. It's a midterm election year. The Trump administration is going to throw everything at this economy. They're going to spend everything that they can. They're going to hand money to everybody, consumers, farmers, anybody that's willing to accept it. They're going to get their guy in the Federal Reserve here in May to print baby prints there, drill baby drill, print baby print. I mean, he's going to do everything he can. He's talking about legalizing marijuana now because he knows it's popular with younger voters. I'm not here making a statement that's good or bad or indifferent. I'm saying he's doing everything he can to make sure he keeps control of Congress. That is very good for markets. It's very good for commodities, very good for inflation. It's very good for demand. If he hands $2,000 to every person out there, usually you don't put that into savings. History says you spend it. Whether you spend it on a movie, popcorn, whatever it is you spend it, you tend to spend it. So if you take $2,000 to, let's say half the people are allowed to get that, and the other half are too wealthy to get that. I don't know. I'm just guessing. But, $2,000 times 150 million or so, you run the numbers, there'll be some significant physical buying of a lot of food and commodities and stuff. The economy is going to rip, in my opinion, because it has to rip if he's going to get the voters to vote for them. And he already handed some money out to the farm community. I have no doubt that won't be the last money that he hands out, because he wants to make sure that the rural states that are very important to winning Congress, that he makes sure that he still loves them. He still loves them, and he hasn't forgotten about that. He still loves them. Whether he does or doesn't, I don't know. But he wants to make the illusion that he still loves them. So all that being said, I mean, it's hard to look at all of that and not be fairly optimistic about the commodity side of the ledger this year. And, and so, I mean, I think that's what I see for overall weather. That's what I see for monetary policy. And geopolitically, I just don't think Trump's going to do anything that's going to piss China off, piss anybody off. I think the tariff thing is going to just completely de-escalate. He can't afford another schism there. He's got to get people confident again. So everything that was a bad thing for hard assets this past season is going to be taken off the table, at least until the November elections. After that, I don't know what's going to happen. If Congress stays on his side, then the following year could be ugly again because he might feel emboldened to go, he may be emboldened to go take aggressive, extreme action again. But for this particular year coming up, he's got to be everybody's friend. That's how I see it right now. So,
yep. I'm going to ask you this question. So 40, 50 years ago, the decision for U.S. agriculture was kind of built around the fact of we're the largest ag producing country on the planet. Corn, wheat, soybeans, we're going to export. We're going to build our entire model around that. With Brazil and Argentina and other South American countries that are building a lot of infrastructure when it comes to agriculture based stuff. You ever think that the United States farmer will take a step back in the various ag, in this season, those things are out there and say, hey, we're going to take a hard look at this from a food, fuel, and feed approach, and we're gonna grow just enough to cover those big three things, right? Make sure we get enough feed, make sure we got enough to grow for biofuels and those kind of things. And then obviously the food side of it, that completely changes the structure of the way the United States looks at it, because we can't continue to keep doing we're going to grow as much as we can and then hope the rest of the world comes and buys it, because it's not working in our favor very well right now. So as you watch this stuff transpire and take place, Sean, do you think that over the next 2 or 3 years, do you see the United States agricultural mindset changing to a different fundamental approach to how the acres that we grow and what we grow on those acres?
It has to change. The export-driven agricultural model, as it is currently devised, it can't possibly work. We are never going to be able to compete with a country like Brazil that anytime that the price gets profitable can plant unlimited amount of extra acres, which they've increased soybean acres by 60% in the last 6 or 7 years. There's just no way to compete with that. So we can't compete with that. Now we can force China to buy our soybeans for a little while, but that's not a long-term plan, right? Right. It's just not. So the reality is, either we have to find someone else to export to that wants to buy from us, that's large enough to handle the excess capacity that we're producing, that China is no longer really needing, or we need to change our model to a domestically demand-driven model, meaning we produce what we need for food, and then anything that we produce above that, we find other ways of using those supplies. And the most logical way to do that, or has been to do that, is to do it with creating economical domestic energy for the country. The problem is that the governments that we've had have not been very clear and consistent about doing this. They do it and they stop and they stop and they do it and they do it and they stop and they stop and they do it and they stop and they do it and they do it. And the rules are just not clear. And so I don't think it's hard. It would be hard to rejigger our economy focused on producing energy from excess production than export. We certainly can do it, but we have to have the political will to do it. And my general feeling has been that the energy industry's influence on our politics has kept governments from fully being able or willing to commit to agriculture to energy policy, meaning that the oil companies and the energy companies, the big energy companies, have not wanted that. They have not wanted energy to go that way. And so it hasn't, it has, but it really hasn't gone as that way enough to really make a material difference on changing our agricultural structure. The good news is more and more of these big energy companies are starting to own more and more of these renewable diesel refining plants, to where it seems there might be a political shift where the energy companies are starting to get more excited about promoting ag to energy, because they now have an ability to make money from it, whereas before they really didn't. And so that is something to watch to see if there is more support from the oil industry, from the energy industry to support ag to energy. Because I don't think you are going to get governments to support that unless the energy bloc is on board, because they just have too much influence, or have had too much influence in Washington. And so I think that's been the impediment, but it absolutely can be done. I think it can be done fairly quickly. And I think it can have a dramatic impact on the economics of U.S. ag industry fairly quickly if there's a political will to do it. I'm hoping and praying that the stars align to start that process in 2026 and really accelerate that as we go forward. The only other avenue that I see other than that, Casey, is India. India is as populous or more populous than China was or has been. They are in the same place economically as China was 25, 30 years ago. They have an educated population. They have a growing economy. They have a growing disposable income. Their demand for everything is growing. They're becoming a net importer of everything. We've been trying to work out a trade deal with them. But if I was to think about, if we are to maintain an export-driven model, if we still believe that that's in our best interest to do so, we have to find a way to see a path towards selling things to India as a way to replumb away from selling stuff to China and selling stuff to India. They have the ability to buy it. They're going to continue to have the ability to buy it. Their demographics are some of the best in history. That may not be necessarily as easy a switch to turn on as quickly as the energy switch, but I think it's there, and I think India is ready, is entering the economic size where they could really be a major demand side player here for the next decade. And if we position and participate correctly, we could be the go-to country for their food purchases. So that's the only other thing that I could see that could really offer enough demand to maintain an export-driven model. So, but because I think that could take longer, my view would be, let's do what we can do quickly here in terms of moving the energy thing forward, and let's develop this India demand base until it gets to a point where we feel confident that we can start leading with the export-driven model again. I think it's sort of not one or the other. It's a little bit of both. Front-end load with the energy side, back-end load with the India demand side. I think that's our best pathway forward. And I think the China situation doesn't mean we won't ever sell anything to them again. I think we'll sell stuff to them if it's in their best interest to buy from us. If we have the best price, we'll sell to them. But I don't think that they're going to be our go-to purchaser anymore like they've been. I think that game has long since sailed away.
Okay. All right. Last question for you. And this is another one of those hypotheticals like I asked you right now. If you look at the dairy market right now, the price of Class 3 milk it's in that mid to high 15s right now, which is not profitable. And if you look at really the big thing that's propping up the dairy market right now is the cattle on beef on dairy programs that you see coming out that have really made a big impact right now just because of where the price of cattle's at. If you look at where the price of cattle is now, obviously it's still high and those kind of things, but we are expecting to see a correction sometime. You know, we've been talking about that for 2 years, so it's going to be a correction sometime, and that correction comes, it's going to be a big one. When you look at the dairy market, where the price of milk is right now, you take away the beef on dairy approach to things because of the profitability that's there. How do you see the milk market kind of suspending itself here over the next 18 to 24 months?
The problem with the dairy market is because of the avian flu last year that propped up prices higher than they should have been. Not only here, but elsewhere. The whole world produced more milk from it, meaning the signal that we gave to the rest of the world, which was temporary. Everyone's producing a lot more milk now than they did a year ago. Europe is producing a ton more milk. New Zealand is producing a ton more milk, and so are we. And so we have too much milk, and there's just no way that I can see that consumer demand where we are right now is going to be able to sop up that excess supply anytime soon. The only way that we would be able to do that is if we, exported the heck out of it. But at the same time, we just talked about, exporting things to others is becoming more challenging. And if everyone else is producing more milk, then buyers would need less of our milk because they could buy plenty of milk from others that are closer by and cost less to ship. It's really a problem because the U.S. dairy industry has not really felt a whole lot of pain yet because they're able to sell those animals for such high prices into the beef market that if you take the beef income, even with the low milk price, they're still coming up with a number that isn't like horrible. So it's sort of creating this illusion of we're okay. But as you said, if you start taking the bank account away of the high cattle price, and we've already seen the market correct here a little bit, but over time, over the next couple of years, as that price continues to fall, and we in the bank account that the dairymen have been banking on to make the numbers work and don't work anymore, it sets up a nasty crisis in the dairy industry if we don't find a solution to sop up the excess supply in the meantime. And so we're not at a crisis point yet. Cattle prices are still good. They can still sell a lot of animals and still bring a lot of income in to offset unattractive milk prices. But, we're starting to lose that bank account here a little bit. And I don't know if it's a food box program again to sop up the supply like we did a few years back that one could argue was very successful during COVID. I don't know, if we just print enough money and hand enough money out to consumers like we just mentioned, and maybe that could be enough to do it. But the dairy industry is in a very dangerous spot, and that it has to be very, very careful about how it handles this period of still okay economics, because the punch bowl of high cattle prices isn't going to last forever. And I hope the industry finds a way to foresee that coming before it becomes an outright crisis, and we need some type of a significant bailout again, which I'm sure the industry would like to avoid, and I think the administration would like to avoid as well.
Right. All right, Sean, good place to stop. If folks want to reach out to you and get more information about what you're doing over at Hackett Financial, what's the best way to do that?
Our website is Hackett, HACKETT, advisors.com. We have a Twitter page at Fairdex11. We have a LinkedIn page. From time to time, we put some things on there about our outlook for weather, for prices in certain markets based on our statistics, cycles, and correlations that those that watch your great show might find of interest to them in wherever they are in the ag chain of command. So,
Well, Sean, I appreciate you being on the podcast. Really glad you're still part of this. You called me out of the blue in 2018, and it's been a fun ride since then. So I really appreciate you coming on the podcast and sharing what you have with the listeners here. So Merry Christmas, Happy New Year to you and your family, and we look forward to talking to you in 26.
Same here. Thanks, Casey. Appreciate it. Thanks.
All right. Stay tuned for more Moving Iron podcasts after these messages.
Well, there they are, mocking you.
See you next year, loser.
That weedy area that's got you thinking, man, I hate that spot. Wish I'd sprayed better. Get the last laugh with a sprayer upgrade from John Deere. Precision upgrades that can increase your sprayer's performance, like ExactApply, advanced nozzles to give you more control at more speeds. It's just one of the many precision upgrades you'll find at johndeere.com. Now, let's see who's laughing.
All right, welcome back to Moving Iron Podcast. I got Brad Graff from Valley Transportation on. Brad, how you doing today?
Good, Casey. How are
Good,
you?
Man. I'm doing good, man. I'm doing good. It's that time of the year where there's enough going on to keep you busy, but enough distraction that you want to go do something else, right? This time of the year, right?
Yeah, for sure.
That's right. Yeah, which I like this time of the year, especially right around here, because you got Christmas parties and those kind of things coming up. But as you look around and start kind of thinking about what you start doing for 26, it's funny that you don't really, I mean, obviously you go through some planning processes and those kind of things as to what, budgets and those kind of things are going to look like. But it always takes me anyway, this last 2 weeks of the year to kind of even start to even get my mind around. It's almost 26. We're going to make some changes or do whatever it is that you're going to do. And one of those things out there is I was always looking for a trucking company that I could, when I was in the equipment side of the business at the dealership, what was a trucking company I wanted to try to find that could maybe make my life easier, save me some money or something like that. And I always start thinking about those kind of things as a people I talk throughout the year. And obviously I loved working with you guys when we were there. Valley, we made it pretty easy. I didn't have to explain that the combine had the big wheels on the front to when they called me on the phone, asked me about if I had any freight anywhere. I thought I'd get you on here, Brad, and we could talk a little bit about just as you're going through the concept of what do I need in a trucking company and how am I going to start deciding that trucking company. One thing I did a lot of when I was working at the dealership was, I get a million phone calls from different truck companies. And it wasn't until I was, 3/4 of the way down the rabbit hole when I started realizing, I don't know if these guys actually have the trucks they're trying to quote to me or not. And what's that mean on the backside when I have an issue? Because the only thing I could ever relate that to was, the Expedia thing, right? If I go book my hotel room through Expedia, then I show up to the Marriott and it's not right, or the rate's wrong, or there's an issue or something like that. And Marriott's quick to point you back to Expedia to go get that taken care of, which usually takes a act of Congress getting anything done once you get to that point. But when you are looking through there, so I guess, Brad, when you're looking at working with a full line trucking company like you have, and you have a freight forwarding group inside of your business too, but if I'm going through the process of trying to figure out what trucking company I want to work with, what are the couple of things that you would point to and say, hey, this is a company you should be working with?
Yeah. I look at it as, if you're going out to a broker and you're getting the best possible price that you can get, we all know the market's pretty slow right now, so that broker's able to find trucks right now. He's able to, he'll find some cheap guy to do it at a minimal expense. But the big thing that you got to worry about is, does that guy got the insurance to take care of what he's hauling? Because that broker doesn't care, because he doesn't really have any skin in the game. Once he brokers it off to that carrier, it's basically between you and that carrier when it comes into legality issues, So, that broker doesn't have any insurance to help cover you typically. So, and the other thing is once the market picks back up and the freight's out there, then those trucks aren't going to haul his cheap freight that he quoted you too low on, so your stuff's not going to get moved. And if you don't have a carrier that you work with on a day-to-day basis, you're going to find that your stuff's going to be sitting and it's not going to get picked up the way you want it to. So I always tell everybody, for sure, work with somebody that's asset based, that owns their own trucks and can move your stuff, because, we get busy too, but if we can't get it moved, one way or the other through our brokerage or through the asset side, we'll make sure that we find a truck and we put it on there and get it moving, so and that's the biggest thing as things start picking back up here. And we're starting to see a little bit of that. I mean, they've taken so much capacity out of this industry over the past 6-8 months that the trucks aren't out there like they used to be, so you're going to find that those guys working with those brokers aren't going to be there and be able to haul your equipment the way you want them to.
Yeah. So one thing on the insurance side, I've never done this and I've never really thought about it because I've never really had an issue yet. So knock on wood that I didn't have a failure and ask this question. But is it a fair question for me to ask? Hey, Brad, can you guys send me a copy of what your insurance coverage looks like for your freight that you're pulling? Was that a fair question to ask?
You should always have that on file. I mean, you should have that. That should be the first thing you do, is make sure that you check a carrier's insurance and what he's got for coverage and, work comp. And, you got to remember that if that driver's out there loading and there's no work comp coverage or no coverage on that guy. If he gets hurt on your yard, it's going to be your responsibility, if they got to fall back on you liability wise. So you should always request insurance coverage from any carrier you're working with.
Yep. So talk me through a little bit on the insurance side of it right now. So if I'm, like you talk, I'm sure there's minimum insurance levels that anybody can get, and they're easy to get and doesn't take a whole lot of effort to get. But you start looking at like an A11, an AFX 11, or an X9 combine or something like that, where you're talking, upwards of $800 to $1 million, depending on what it is.
Yeah. Talk
a little bit about the process for a company like you to get $1 million worth of insurance, and what kind of hoops you have to jump to make that happen.
Yeah, it takes time. Over 40 years, I didn't start out having $1 million worth of coverage. So we over time, we've just been building it up because of the amount of coverage we need just to take care of that. So most carriers out there, they'll run a $250,000 cargo insurance policy. So if you're not paying attention to that and you put a $500,000-$600,000 tractor on there, the biggest issue with that is if they don't have enough coverage to cover what's on the trailer, it automatically, most policies resort back to zero. So if they don't have enough to cover what they damaged, they go back, they don't have zero coverage for that because
really? So if I have $250,000 example and it's $300,000 worth of damage, it's the same as zero?
Exactly.
Oh,
so
wow.
Wow. So then it's going to come back on your company's insurance in order to pay it, So that and most policies are written that way because they want to make sure that these carriers have the insurance they need for what they're hauling. So they write that in. We've seen that with some other carriers that have tipped some cranes over and stuff that we know of, that they had like $250,000 worth of insurance and tipped over $1 million crane, and it fell back on one of our customers. It wasn't us, thank God, but the reason they did it was because we couldn't get to it as quick as they wanted it. So the salesman went out and hired his own carrier. They rolled the crane about 6 miles from the factory. It was a bad day for them because the carrier didn't have any insurance.
Wow.
Yeah.
That's bad. Wow. Okay. That makes all the difference in the world then, understanding why you have make sure, because I'd never thought of that. All these years that I was doing, I just assumed that everything would work out like it was supposed to, and never once crossed my mind to make sure to say like, but we're also talking back in the day then, when I was doing this, it was, there was some expensive stuff obviously towards the tail end of my career, but when I first started doing it, you were selling $40,000 tractors and, $100,000 combines, stuff like that, which I would assume most about anybody had that much insurance when they're doing it. But again, all about due diligence, and, sales guys, they're really on the due diligence side of dotting I's and crossing T's when they come to looking at all the stuff that's out there.
Back in the day, we used to load 340, 430s on a load and never came close to what an 8R 410 is,
I know. Yeah. I remember the first time a guy told me, like, I can only load one tractor at a time now. And I'm like, since when? You've been loading three. You've been loading three the whole time, eh?
Yeah.
But new model comes out and it's twice as much, right? Doesn't take long for that to happen. So what are some of the things that you would ask question wise if you're going through that process? Talked a little bit about it earlier, but what are some of the questions you'd be asking a carrier to make sure that they've got the insurance stuff they have, getting those kind of things away, but just kind of filling your way through that to make sure that you're talking to an asset-based company like Valley Transportation versus just a guy that's working out of his basement, brokering freight.
Well, most of, I think right away, you start talking about the equipment and you can tell pretty fast what kind of knowledge they got on what they're moving,
Mm-hmm.
So, typically them brokers, they're not gonna, if they don't know anything about what you're trying to move, I would shy away from them fairly fast because it's obviously that they don't move that kind of stuff very often, so the questions to ask is the asset base and get a copy of their insurance, get a copy of their work comp, because that tells you that they got employees and people on staff that they got coverage on them, A lot of these brokerage houses, they won't have any work comp because they don't have that in front of you, or that type of coverage. And just find out how many trucks they got, how many trailers they got, how long they've been in business. Just basic questions to get a good feel for who you're working with.
When you start, another question too, I guess I always thought about too, and I think this is more on, the kind of the level of company you're working with, but is there like going around and asking questions like, could you send me a copy of your DOT record or something like that, or your maintenance records or something like that on your machinery? Like, is there an easy way that you can get that kind of information to make sure you're dealing with someone that's got good quality equipment and not necessarily just some stuff they're trying to keep patched together? I'm
pretty sure you can go in and pull up their their safer score, so you know as a carrier how safe they are. So there's a score in there, and I think you can. I would have to get with Carson to remember how to do it. I think you can just type in the carrier and pull them up, and it should give you some of that information. So there's also a way that we can get that figured out, that you can look up and see how many trucks they're showing, on the DOT's website. Mm-hmm. So pretty quick, you can find a lot of information out on a carrier, so.
Yeah. So last question I have for you on this, Brad, as you're looking at things kind of rolling their way through. One thing I always ask guys I was just kind of feel around for a little bit, I'd ask them questions like, when was the last time you hauled a combine, and where to go to, and those kind of things. And, kind of find out a lot of those guys would be like, well, we're mostly a van company, but we've got, a couple flatbeds, or we've got some step decks, or we got, we just got a detached. Now we're ready to go out and really be in the heavy haul side of the business. When you're walking through that, questioning folks, how would you start that question of like, finding out what their primary focus in the trucking side of the business is?
Yeah, I guess, you just talk to them about how much equipment they do haul. Is that their primary source? What are you hauling? Ag equipment? Are you hauling construction equipment? What type of thing are you hauling? And then quiz them on, what's a 7720 or 9500 or,
right.
Start quizzing them on some of that stuff, and just ask them, maybe you're hauling a piece of equipment, and when they start asking you for the dimensions and what it, what it looks like and how high it is, and will that fit on a flatbed?
Yeah.
You're going to know pretty quick what if you're putting an 8R on a flatbed, you can start questioning, marking them off,
Yeah, that's I love that question. Well, how tall is that? And if you were like, how wide is that? And what kind of trailer do you think we should be using for that? I'm like, dude, you're the trucking company. I'm just telling you what I got. So
right.
There's a million places you can go. Yeah. That'd be funny. I haven't had that one yet, but that'd be funny.
It happened.
I'm sure it has. I'm sure it has. Brad, as you're looking at the market right now, 25 has been a rough year for everybody. But as you're looking through there, you kind of talked about, you started seeing some stuff warming up a little bit. You've seen some more stuff kind of come and go. And what are you seeing move right now? And what are you seeing and where are you seeing most of the stuff go?
Yeah, we've had a lot of good conversations. The slowdown in the market forces us to get out and visit with our customers and do more of that. So we've had a lot of conversations, and the majority of the people we're talking to seem pretty optimistic about 26, that it's going to be substantially better than 25. So I think we're going to feel that getting better. We know we're starting to see spot quotes jump, and a spot quote is anything that's not, under a annual type of a contract, So Joe Blow calls us and wants us to bid something, that's a spot quote. So we're seeing the rates jump up. I think through the industry, they're talking 40 cents a mile higher than they were back last summer. So we're starting to see that pick up, So I watch that spot quote rate, pretty close, just to know what other carriers are doing and what people are getting quoted. So we got a pretty good feeling that it seems like things are picking up. Our business throughout the last quarter here. Probably heavier in construction than it has been in ag, but we did see a little spike in ag that kind of makes us feel a little bit better, like things are maybe moving a little bit better, So I think ag was really quiet through the second and third quarter this year, So
Yeah.
we just didn't. There were very little, if anything, was moving. So,
Yeah.
we watch. We got our yard in Waterloo there next to the factory where the tractors come out, and it's not very often you see them parking lots empty of tractors, but there was quite a few weeks there where there was hardly anything even sitting there. So
Yeah.
yeah,
It's been slow. It's been slow for sure. That's kind of working your way through that. All right, Brad, new rules, new regulations coming out about, how to get a CDL and what that looks like and all the stuff that comes with that. When I got my CDL way back when I was driving the beer truck when I first got out of college, you just kind of went down to the DMV and they took you around the block and you had to back between a few cones and you got your CDL. It was pretty simple, right? You did a walk around test and that kind of stuff. Local community college, I can see from my backyard, they got trucks running around all the time. They're training guys how to do stuff. It's not as simple as that anymore. You got to, it's a fairly expensive endeavor that you're going through, and I personally think you're isolating a bunch of people that have been driving trucks on farms and those kind of things their whole life, and now they go out to do it the same thing they've been doing for the past 10 years of their life. Kind of flipping that around a little bit. I don't know a lot of folks that are going to spend the money or time to go do that. So I just love to have your opinion on how you're looking at this thing now and what this mean for the trucking industry.
Yeah. It's going to get a lot tougher for the industry because it's you're looking at a 3-month school to go through and a lot of dollars to get through there to get your CDL. So if you don't have your CDL already, it just the entry level to get into it is just so tough. I say, like, we got these kids out here driving grain trucks, and on the farms and still running up and down the road. They don't need a CDL to run for the farm, So they know how to drive the truck already and do the work. But are they going to go to that school and put that time in to get their CDL to become an over the road truck driver? We see a lot of them going away from that, So I don't think the industry did themselves any favors by doing what they're doing. But there's a lot of pushback on that, and a lot of people that say they need the training. But how come we turn them loose at 18 and run a grain truck up and down the road if they won't let them do anything else?
I kind of feel like that's training enough. You know what I mean?
So. And then they tie their hands from 18 to 21. They can't cross the state lines, So we sit here 15 miles from the Iowa border. We're 90 miles from Waterloo, but I can't send an 18-year-old that's got his CDL to Waterloo to pick up a tractor to come back to Minnesota,
Yeah.
They got to get some common sense into this thing. It should be a 400-mile radius instead of a state line rule, and because I could see that, I mean, I would love to be able to send 18-year-olds to down to Waterloo to load tractors and then just come back up here and deliver in Minnesota somewhere,
Yeah.
Because we got a lot of that type of freight. But by the time you run somebody that's old enough, 90 miles down, 90 miles back, and then switch and take it from here, it doesn't work so good for us. So
yeah,
we see a lot of things that need to be changed in that driver regulation, and it's just tough to get them changed. We do a lot with the MTA, and the MTA does a very good job about, trying to get these rules changed that aren't working for us. But it's a tough go to get anything changed, as you guys probably know. So.
Oh yeah. I don't know too many politicians when they make a law, they go back and repeal it very, very quickly. So
no.
It's like pulling teeth to get anything done. So yeah, you're right. There's a lot of common sense stuff that, just like you said, right? They work on the farm, driving grain trucks during harvest and everything else without any training or anything else, and for whatever reason they can't go past that. And if you haven't been around harvest time, even in these rural country roads, they're pretty busy. So, and they're pretty narrow too. So it's not like they're they're out just driving around in some field with nobody else around them. So I watch those guys out there doing that, and I kind of shake my head sometimes. Like, I get it, but at the same time, it feels like you're putting in one more level of bureaucratic red tape in the middle of something that's already got a lot of bureaucratic red tape in the mix.
Yeah, for sure.
Yep.
And especially with our business, that 18-year-old kid that's out there jumping in and out of that grain truck, he also jumped in and out of tractors and skid loaders and combines and, knows how the planter works and, knows how they fold up. He's not just learned, just there driving truck. He's running grain cart and doing everything, so.
Yep.
And that's how I grew up. I mean, I learned it all by doing it, and these schools are okay, but to me, I think I can train somebody a lot better how to drive a truck than these schools do.
Yeah.
And we bring them in here and, we'll put them on a dry van or something, and get them so they can drive the truck. And then, you got to be around this stuff to learn how to do it.
Yeah.
You just don't go to school and figure it out in 90 days. So,
yeah.
The problem is they're trying to train them on the stuff they really don't need to know. They're trying to train them on logs and all the stuff that those they think that's a safety issue, but to me, I think you better teach them how to drive the truck and handle the equipment and run the stuff and let them be their own judge. So
yeah,
get a little frustrated with some of their ideas because none of them ever been in a truck and they don't know what they're talking about. So
yeah, you turn a corner sometime, you don't have something strapped down right, and it comes flying off the edge of that.
Yeah,
that's significantly more important than. And everything now is all electronic log anyway. So I mean, it's not like it's doing it for you, right? You just click the button.
Right.
If you're on duty or off,
It's going to take care of that. You don't really need to know all that. So
yeah, that's enough for you.
You got to know it, but how long is it going to take? It's not going to take us long to teach that. So
no, lot more other things there that are from a safety perspective,
right?
That make a lot bigger splash than your logbook stuff for sure.
Yeah,
for sure.
It's you just got to live it and do it, so it's the only way you're going to learn it. So
for sure.
They go into these schools and they haul cement blocks around that are 4x4 square that wouldn't fall off that trailer if you had a skid loader to push them off,
Right.
So it's a lot different than hauling a 12-row corn head standing up on a headstand straight up and down, and you got to figure out how to tie it down so it don't lay over on its side,
Yep, for sure. And going back to your $250,000 worth of coverage, that would barely cover some of these corn heads coming out of the factory anymore. You know what I mean?
That's a bad deal.
I'll tell you what, they're not cheap anymore. Not cheap anymore. Well, Brad, it's probably a good place to stop. Appreciate you being the podcast. If folks want to reach out to you over at Valley Transportation, what's the best way to do that?
Yeah, they can call in here to the CSMs at 800-657-4910 or check out our website at valleytransinc.com.
And Brad, I really appreciate what you guys have done for the Moving Iron Summit over the years. You've been a long-time sponsor of that, and I really appreciate you guys being a part of that.
Yeah, thanks, Casey. Works well for it.
Well, take care, Brad. Have a Merry Christmas and a Happy New Year, and we'll talk again here in 26.
All right, same to you. Thank you.
Stay tuned for more Moving Iron podcasts after these messages.
Get the latest market, weather, and rural news whenever it works for you. Farm Journal TV is on Roku, Fire TV, and mobile. Try it for free for 14 days and take ag with you everywhere.
All right, welcome back to Moving Iron Podcast. Got Aaron Fennell back on to talk about what's happening in the market. Aaron, how you doing?
Terrific.
Outstanding.
We're on the way downhill slope of 25.
Yeah,
we've even passed the rumble bars.
We skied down the slope, and now we're having a few cocktails in the whatever they call that thing, the lodge down at the bottom of the hill now. So 2025, obviously everyone, I'm glad it's over with because we're on to bigger and brighter things now. But when you look at how things are playing out, first off, let's just get a quick temperature on how things are right now towards the end of the year. We've been talking about this for the past, 6 weeks, that, it's a lot of folks are coming in and buying stuff because, hey man, I don't necessarily want to do this, but I'm going to do this now because I have to. some tax reason involved, or hey, I need to update machines, those kind of things. Since we had our last podcast, we were anticipating that this last 2 weeks here. So we're recording this on the 23rd of December. We were anticipating the last 2 weeks that there's going to be a big rush. What are you seeing so far here this last week this truly last week of the year before things really shut down?
It's as though everybody's phone service got restored yesterday. We've been talking about last minute Larry all year, and combined with the have to, and that's what it is. That's exactly what it is. Phone rings off the hook, and everybody is trading things with a lot of hours. So,
yeah,
1 + 2. There you go. That's where we're at. It's like even, and it seems more just personal experience. It's more pushed to the wire than ever, which we talked about, where interest isn't 2%, and machines aren't 100,000. So you're going to buy $400,000 and it's 5%, then, well, don't do that until we have to. And that's welcome to the window we're at. So there's a lot of that going on. A incredibly wide product mix. We had a real good run the last, I'm going to say 45 days on loader tractors, of course.
Yeah.
Some livestock industry tax issues, if you will.
Which
for once, that's a problem.
Yeah.
And a lot of guys didn't just buy more wire and duct tape. So, there you go. Yeah. Once every 20 years, you got to update that loader. A lot of that, and that has really curtailed. Now we're into, I'm not going to, none of that 100-hour stuff, but it's big ticket, what I would call big ticket, high value row crop farming. 24-row planters, large 8Rs, 9Rs, big combines, big stuff, high dollar stuff. That's what is really been popping I'd say the last week, filling out the end of the year. So kind of wild. Yeah. I expected I expected a lot of loader tractors, and then kind of what I've been seeing through the year, starting in summer, a lot of those 5,000 to 10,000 hour guys call, looking ahead, looking for, which as a dealer, you always hate that guy calls in August. Well, if you still got that in November, like, God, I hope not.
Yeah.
But, excuse me, that's kind of the world we're in. I hate to do that, but we're not in a super fast-paced environment right now. But those guys that got the 5 to 10, I expected them to really show up and grab the repriced back into the market 8Rs that exist, but not a lot out of that crew, so to speak, yet. More what I would call the 2 to 5 is what's been on the tractor world. The combine and sprayer world is where the high-hour calls are coming for sure.
Yep. So that's funny you bring that up. I was talking to about this the other day.
But real quick, let me put this in there, Casey. I should take that back. At the beginning of December, it feels like I talked to a lot of guys with that 2010 to 2015 mix of machinery. Okay. Early S combines, late 70s, early 8Rs, late 30 series. And had the discussion with every single one of those guys Absolutely. I'll trade for that all day, every day. But here's my problem. My dealership, your dealership, the wholesaler, all the auction companies, that item has one price regardless of where you're getting it. We are all the same number. So you're going to take your auction company minus their percent. You're going to take us dealer minus the freight, minus the shop, minus. You now have 3 levels. You, the auction, the dealer. And whoever's doing it, it's all the same price. I mean, that's the beauty when you get in that 10 to 15 product mix, 10 to 15-year-old stuff. Private party dealer auction is, I mean, that's all about the same number. And the guys know it, and they're like, yeah, unless he is adamant, the guy's adamantly against it themselves, you know, absolutely don't want to answer big iron calls. They do not want to answer, hey, I saw your tractor on Tractor House. You know, those guys, they're always going to trade. But for the guy looking to maximize every penny, you know, those discussions go a hell of a long way to kind of walk them through it. And, oh, yeah.
I had a conversation with a guy the other day that was very kind of those things where it's been in front of your face the whole time, but you didn't really think about it until you had to start explaining why it was happening.
Right.
And the conversation I was having was revolving around pre-COVID, during COVID, post-COVID equipment, right? And the pre-COVID was, you know, guys were coming in ready to buy stuff, buy that used piece off that annual roll or whatever it was they were doing, and because of supply chains, that new piece got canceled or whatever happened and just got disrupted. And it might have been 2 years or 3 years down the way before the machine they were waiting for actually got back in. And by the time it got back in, the price was so high, the trade difference was so high, it blew their mind. And they just like, what do we do with my hands, right? Type of thing, right? And as they were coursed their way through, well, now they've hit this like, man, we've never put this many hours on anything like a sprayer or combine or whatever.
Oh yeah.
We're 3 seasons past normal use, those kind of things. And that was the conversation I was having. We had this conversation before, but you know, what used to be, you know, 750 hours is now 1,500 hours type of thing, right? That's like the new normal. And as you watch those things move through, the biggest part of the conversation I was having with this guy was that the thing about those hours is that the price range just moved with the hour expectation, right? So, but used to cost $750,000, what that price range was now has not like it just traded to 1,500 hours, but a big chunk of that, let's just say it was $100,000 when it was 750 hours. It might be $85,000 for
or 95
hours. You know what I mean? Like,
yeah,
like it's just a slight tick. It's like a slight crank of the nozzle back a little bit, but whereas in the past, so if it was $100,000 for 750 hours, when you got to 1,500 hours, it's $60,000, $70,000. Like there's a dynamic difference between the two. Now those things just aren't. It's not moving like that. And as you watch these things move through, to me, this is where you start seeing the stabilization of the marketplace. Number one, and the stratification of the customer buying groups that are coming in and buying this stuff now. If you go and look at where inventory levels are and how inventory is moving, that 3 to 5 year old stuff, which I talked about last time, that I was like, man, I'm kind of worried about this. There's a lot of 3 to 5 year old stuff out there right now. It looks like that's the stuff that is just getting pounded right now from buyers that are looking to buy stuff. And they're growing that, and you're growing that 6 to 10 year old marketplace.
That's where.
So that's to me, that's a really healthy marketplace. That's what I think. That's why I'm saying when I'm looking at 2026 right now, the marketplace is becoming very, very, very stable. I'm not saying it's like very, very good as far as where pricing's at and those kind of things, because the 3 to 5 year old stuff, the dynamics and the pricing of the 3 to 5 year old stuff compared to a 1 or 2 year old pieces of equipment, that cascading price that we'd see, 5 years ago, 6 years ago, where, all right, cool, the first piece is whatever 25% back or 20% back of a new one after 200 or 300 hours, and then you're going to take off an additional 10% on the second year for a 2-year-old piece with an additional 250 hours. In the third year, you're going to be about 5 to 7% back. Like, those rules don't apply anymore. It's like, here's a 1-year-old machine, here's a 2-year-old machine, and then here's a 3-year-old machine all the way down here. Right. As far as pricing goes, there's a huge gap in between. And I'm not saying that's right or wrong. I'm just saying that's where it's at, because the thing about the used equipment marketplace, and this is like 101 stuff, you have to price used to get the used buyer to want to buy it, right? Well, those dynamics now are so a class 10 combine, class 11 combine is a great example of that. You're seeing you're talking an AF 11 or a X9 or whatever you're talking about, an 8800 class, whatever it is. All those machines list price are close to $1 million, right? They go out and sell them. They bring them back into the marketplace. And what's the market? What's the auction market and retail marketplace saying the market is for those machines?
Somewhere
between $575 and $650 for a 1-year-old machine with a season of use on it. That's where the marketplace is at. Now, you read the stuff online. Oh my God, these things are. Who would ever buy one of these things? Da 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 da.
People that want to get a lot of shit done really quick.
Right. It's not that these machines are worthless. It's that the anticipation that you have of the machine when it comes back in your mind should be, well, I should be rolling it back, $100,000, $150,000 should be about what I should be used or whatever. But you got to remember, you got to think about the number that's there. That's got a 9 in front of it when you buy it, or an 8 plus a 9 with a 0 and a comma behind it, or whatever it is. 875 to 950, whatever that number comes out to be. You roll back $100,000 off that when you bring it back in, $150,000 when you bring it back in. The only person that wants to buy that $725,000 piece of equipment that you're talking about is the guy that just bought the new one, because the used buyer is not going to spend $700,000. So in order to get a used buyer interested in that machine, you have to bring it down further. So what I'm saying in all this is that the anticipation that machines, when they come back to the marketplace, that you're going to see this plethora of 1-year-old with season of use, high dollar equipment I think is out the window. Guys are going to be looking at big, 700 horsepower quad track tractors and 9RXs and those kind of things. When you're spending $600,000, $700,000, $800,000 on something, well, more than that, $800,000 or something like that, and you go trade it back in, and the dealer puts it out there for $759,900 or $775,000 or $799,900 or something like that. That's you're a new buyer at that point, right? The idea that the machines are still going to be there with a few hundred hours on them or those kind of things, but they're going to be a small part of the marketplace. Machines are going to have more hours on them because people are going to be running them longer.
Right.
And as they run them longer, they're going to have to run them longer so they can get more and more of this equipment to pencil out, just like a dirt contractor, right? They go out and spend $1 million on a D8 dozer to go push dirt around. But the difference between that dozer and these other pieces of equipment is they're going to go out and run them 24/7, 365, and they're going to put the hours on them, because the more hours they put on them, the more money they're making with them. And I think that same concept is not going to bleed over into the farming side, where the idea of hours on machines is going to be such a part of the conversation now, where they've got to be like, we can't buy this and then go plant our crop and let our machine set for 8 months out of the year, 9 months out of the year, 10 months out of the year. We've got to utilize that machine the best way we can, and how can we go do that? Or we got to stretch this across multiple years and put 2, 3, 4 seasons of use on it before we take it back into the marketplace.
Right. Well, back to your point. Go a few years back when a new combine was $5.
Yeah.
Right. The 1-year-old used $4, $4.25.
No.
That's enough gap. Catch guys all day, every day, all the time. Okay.
Yep.
Now you're 8. You can't do 7.
Right.
The guy that's buying this just bought this. Okay.
Right.
Can we do 6? I don't know who we're going to catch at 6, but 5 will work. Where's this coming from? That right now is one of the 2 biggest challenges in the equipment business. New is so expensive that you cannot get used to hit where used needs to be for used to move.
Right.
The other point of that, because of the 21 through 23 glut and all of that's still getting sorted through the marketplace, back to your, what you talked about early on, we started these podcasts with the glut sitting there for the most part yet, or at least half of it. And it was, what are we going to do with all this 1-year-old stuff, right? This late model, low hour is not the desirable machine anymore. Everybody's loaded up. What are we going to do? Well, we all went and traded for 6 to 10s. That is what, of all the segments, that's the one that scares me to death right now, that 6 to 10. The reason it worries me is the numbers aren't right.
Yeah, I think there's something to it. I mean, yeah.
They were still holding their own while the glut was fixing, right? Mm-hmm. So they're still holding their own. The glut's coming. Now you got a 19 8370R with 2,500 hours for 300, or a 21 8R370 with 2,500 hours. That's only this much more.
Yeah.
Do you see what I mean?
Yeah.
The 4-digit tractors in our green world, the 4-digit tractors, what was there, because they weren't everywhere. Remember, COVID almost wiped them off the map. Anything from 10 to 19 that was desirable.
What do you mean? What do you mean by 4-digit tractors? What do you mean by that?
8370R instead of an 8R370.
I'm tracking. All right.
Yes, because they're both 8Rs. It gets incredibly confusing for the non-dealer guy. Yeah. So the 8XXXX, those tractors, they never were really getting adjusted till this fall.
Right.
And there's a lot of those out in the world that are super wrong. I would say in a dollars per investment, there's more wrongness there than there is in 1 to 3 or even 1 to 5.
And that's what we talked about last time when that 3 to 5 year old stuff is, that where that band of stuff's at, that's where the biggest chunk of that stuff's at. Now we're going to see some of that get knocked off the top right away, and we're seeing that happen right now.
We're seeing that, yeah, through year end.
Right. And you're going to see that happen. That's going to kind of come back in and reset the marketplace where those machines sold at. They're going to go back and readjust after the first of the year, start watching those things move through. I really don't anticipate seeing a lot of movement in the first couple months of the year, just because of the move we're seeing now is a lot of like, hey, we have to get this done right now because it's a tax thing. There could be some deferments over, into that, but
well, if it's a deferment, they got 365 days to handle it. So
right, that's what I'm saying. So like, they'll be like, okay, we got a little bit more time to kind of figure out what we're doing. As the 6 to 10 year old stuff comes in, what worries me most about 6 to 10 year old stuff is there's plenty of guys out there buying 6 to 10 year old stuff, but the volume of equipment that's coming down, that's going to move its way down from 3 to 5 year old stuff to 6 to 10 year old stuff, that there's not that many to cover that.
You're halfway down the hill with that 6 to 10, and there's a big rock a rolling.
Big chunk coming up behind it. And I think that's there. One more thing on this, my point earlier was the dollars. It seems like, oh my God, these things have just completely. It's like throwing a rock off the side of a boat and watching it sink when it comes to used marketplace. The percentages are still the same. If you go back and do the math on all the stuff, where these things are coming in at, and it's one thing to price it from list price to what auction value is, but that's a mythical unicorn number that nobody uses. And where they're actually being sold at, it's still 25 to 30% for a 1-year-old machine. It's just that 25 or 30% is $250,000, $300,000.
Right.
You know what I mean? That's the conversation we're having now.
The percent is the same. The number that the percent is doubled.
Where the 3 to 5-year-old stuff comes into play at, though, what the big thing on that is that stuff, because of where it was priced at through COVID, and which that's a lot of that stuff there, right? Depending on where it got booked at, was it before a price increase or after a price increase?
Right.
Was it like what was going on? Because it might be a 21 model machine, but by the time it got delivered, it might have had 2 extra price increases put on it.
How
and God
quickly
forbid
did
if
you?
it was a 22, it might have 3 or 4 price increases on it.
Well,
by the
yeah.
time it got to you.
And how quickly did you, in your own brain, as the used equipment guy, get rid of the scarcity premium? There's some of that too.
A lot of that.
A lot
So
of
that stuff, but a lot of that stuff's been corrected now. So when I'm looking at 3 to 5-year-old stuff, I think we're good today. What's it look like in March or July? That's a conversation we'll have to have then. And I think it'll be. I don't think it's going to be some huge fall off the cliff type of thing, but I think there'll be a little bit of we're going to wax out a few scratches here,
right,
that are still just in the clear coat and not all the way through the paint. But as we kind of push our way through that 3 to 5-year-old stuff, in my opinion, has the best chance in 2026 to get completely clean and completely washed out. When you look at the 1-year-old stuff that's the 2025 model stuff now, the 24 model stuff that's out there now, I think 24 model stuff has a really good chance of getting kind of cleaned up as well. The 25 stuff, again, I think you're going to start going back to. I'm a 1 to 2-year-old buyer, and I've got some 3 to 5-year-old stuff that I want to trade in.
Yep, I think we see that guy coming back.
You're trading into a marketplace where I've already got 10 of those on the lot, right? And I think that's going to be that. It's going to be a little bit of a harder transaction than I think we've seen in the past. Like this last time, when dealerships were trying to get stuff off the lot, those 1 to 2-year-old machines off the lot, and you had a 3 to 5-year-old machine you were trading in, they were making, let's make a deal. Let's do this. Let's do this. Let's do this.
Oh yeah.
And I don't think
now
that
you
let's make a deal. Now you're still going to want to make a deal, but it's going to be a different structure and how that looks and what those things come through. It's going to change a little bit. I look at 2026 as a chance to clean up used inventory in a manner that we haven't seen probably in my 20 years doing this. But I also think it ushers in what the new normal looks like moving forward. And that's going to be less equipment being sold, more used equipment, longer hours or longer transition hours on the farm, going from I would typically trade my tractor every year, now I'm going to trade my tractor every 3 years. The number of machines on the farm is going to shrink. Like all that, we're starting to see that happen now. And one other thing I'll throw out there too, and I've talked to a lot of folks, and you and I talk all the time, but other guys that do similar things where they're a used equipment guy taking in the phone calls from all over the place. The conversation that you hear from folks is really simple. I really enjoy buying and selling equipment this way, where I can talk to you on the phone, and I'm just looking at the piece of equipment online, or I enjoy I like the experience of buying something at an auction better than I do buying it from a dealer. But when I can talk to a dealer online, and I'm 2 states away, and I'm just doing like buying it that way, you're seeing more and more customers that are not transition away from the dealer, because that's not what I'm saying. But what they're saying is the idea of me having to have the conversation with somebody on my farm is not something I'm wanting to do anymore. I'm wanting to do more via text, via phone call, via email, whether that's from my local dealer or from a dealer 2 states away. That's how I want to do business. And you're seeing that more and more as the next generation comes into play. More than I even 2 years ago. Like, I prefer text, but how come I haven't come to my farm for a while? You'd hear that conversation. Like, all you ever do is want to text me. It's like, well, that's what you said you wanted to do. Well, now it's like, really, just text me, just email me, just call me. If you want to come out once in a while, great. But I got a lot of stuff going on. We can do this. And I'm the same way like buying a car. Like, next time I buy a car, I'm not going to go to a dealership to buy a car. I'm going to text.
Dude, I didn't go to the
do all
dealership.
that stuff.
I just bought a pickup last week, and of course I bought it from a buddy, but still, I seen it online. I shot him a text. Okay. That's it.
And like,
to your point, Casey, to your point, as somebody who does what you're describing, the seller in that world, we live in a world where, that happens all day, every day. That's why I exist, is I sell to guys out of the area, and little things go a long way. You get off your ass, go the extra mile for him, make it so he feels like, why in the hell would I go look? The guy sent me 100 pictures, 4 videos, shop history. Make it easy for him. That's it.
Yeah.
And in the world of technology and all this shit, there is no way it's a layup to do all that for him.
Yeah. Yeah. And you can do, it's the same concept. You can contracts and all that kind of stuff. You can get that stuff signed.
And for the dealer listening, or whoever's selling the machinery, I personally do it this way, because I've had, discussing this with other guys in this role. Dude, all you're going to get done is chasing your tail all the time. No. You talk to the guy, you share the info. He signs the PO. Now watch the extra mile. He's willing to sign the PO. Yep, as long as it's blah, 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 here we go. Then forward march, here we go. Yep, I's dotted, T's crossed, done.
Yeah.
Simple. Works for them, works for you. And it's no different than the local guy at all.
Yeah. Yep. And I think that's just the concept of that, is just the ease of that and the transparency that you're giving them, work orders, all other stuff that you're putting out there in front of them, so they can see everything.
When you send them pictures, point out a leak.
Right.
Point out a seat tear. Point out a weld.
Yeah. Be completely transparent about what you're doing.
Yeah.
I think those are the things that you have to have, that you need to be ready for, because that's this. I've always been saying that. I've said that for a long time. Like, these guys want to buy online, but it's always been kind of like, someday they want to buy online. Well, I think that someday's here, and the trend. 25-30% of the population is still going to want you to come out and do the traditional,
right?
The traditional approach. But man, I tell you what, there's 80-85% of the people that are out there would just as soon never talk to you other than just, you send me what I need to sign, or you send me the information I'm looking for, and move things forward. So as you're working your way through this, and these systems open up, there's not a lot of 1 and 2 year old stuff on the marketplace right now.
Right.
If you just do the simple math of all the machines that are out there on the 1 to 2 year old stuff, I mean, there's 6,700 dealership locations, all makes, all models, all manufacturer stuff. There's 700 1-year-old 300 plus horsepower tractors out there, and that's everything from a 300 horsepower row crop tractor all the way up to an 830 horsepower 4-wheel drive. That means that there's one every 4 locations, right?
Right.
That you do that. Well, it'd be less than that, but or more than that. But it was just, the point I'm making is that guys are going to be calling from all over the place if they're looking for a 1-year-old machine, because they may not have any 1-year-old machines at the dealership that they're talking with. They might not have any.
For sure.
So that door is going to be wide open now for a broader spectrum of buyers to be looking at stuff across the way. That door, though, is pretty narrow, because the number of buyers that fit through that door, is significantly smaller, right?
It's not
$600,000 buyer, right? Right. And a $600,000 used buyer is, or I'd say the band for that idea is probably what, $450 on the low side to $650 on the high side, maybe
Yeah.
500,000 to 650, something like that. There's just not that many people that are out there looking for that.
No.
But it's no different than in past worlds where the guy wanted to buy a $300,000 used combine, right? That was, granted, there were more people that were in that band, but it was a limited number of people, right?
Right.
And that's just those bands have shrank, and some bands have grown, and I think the 3 to 5 band has grown quite a bit in the number of customers that have come to that band.
Yeah.
I mean, it's probably tripled. But which then what happens to the 6 to 10-year-old stuff? And that's that to me talking right now. Half of that stuff's got to go to an international market, and that's where it's going to have to go, because you're going to run out of the stuff coming anyway, right? Half the stuff that's going to come into that bucket has to go international, because that's where your wide range of buyers are going to be at. So,
Yep.
Anyway. All right, good place to stop, Aaron. Folks want to reach out to you and get High Plains Wholesale's deal of the weeks. What's the best way to do that?
Well, High Plains Wholesale has a Facebook page and a TikTok account, though we've been on break since Thanksgiving. We're going to hit her hard after the year. Lots of videos on there. You can look, check out what we do, see the gimmick, if you will. You can catch those same videos. I also just share some different items here and there on my Twitter, which is by my name. I'm also on Facebook and LinkedIn by my name. And you can call me or text me anytime, 308-760-1193. Willing to talk iron, or let's do some dealing.
Right on. Find me on Facebook, X, Instagram, I think TikTok, I don't know, LinkedIn, all kinds of places you can find me. At Moving Iron LLC or Moving Iron Podcast, 1 and 2. You can also go to the Farm Journal Ag web page, and you can see the audio version of this under the podcast section. You can also go to Farm Journal's YouTube channel, where you can see the video version of this, and it'll show everything you need there. It's been a great year. I really enjoyed working with everybody here at Farm Journal and getting that year under my belt, and I'm glad that that's happened. Aaron, appreciate you being on the podcast. As always, man, we've been doing this a long time together, and I really appreciate you being on here. So we'll check in there. Greg, Machinery Pete Peterson, appreciate you being on, as well as Sean Hackett, Chip Nelliger, Rich Posson, and all the other great folks that are out there, and appreciate you guys being a part of this. So with that, I am Casey Seymour. Hope you guys have a great 2026. Let's go smart, folks.
Thanks for joining us. We'll see you again next week. And remember, Moving Iron is available on Farm Journal's YouTube channel and anywhere podcasts are found. So until next time, let's move some iron.